we're all counting on from the Federal Reserve doesn't actually happen? Or what if it's a lot farther away than we all kind of hoped it would be? Well, that's what I'm going to explore today. So, welcome to a very special episode of Shut the Fud Up.
Sometimes you just gotta shut the fud up.
Hey man, just want to let you know that sometimes you gotta shut the fuck up. You gotta shut the fuck up. And this current time is just one of those times you gotta shut the fuck up.
I don't think you're a bad person, I just don't want to hear you talking anymore. You gotta shut the fuck up.
All right. So even though, usually I'm you guys' bullish positivity prince that is always giving you optimism and everything. I mean, don't get me wrong, I'm still optimistic. I'm still very optimistic. Still believe that nothing but good is in our future here. But we do got to acknowledge what's going on in the market today. We got to acknowledge possibilities. Now, today what I was supposed to have was a debate with a guy named Pedro. And he was supposed to be really bearish and thinking that the bull run was all over, and we were supposed to go on Max's channel and argue that. But then, as the week went on, what happened was he started sounding less bearish. He started saying, "Oh no, I don't think the bull market is totally over. I think we might have another 6 months left in it, maybe another 12 months at most." And I was like, "Okay, well that's not too different from what I think." And we ended up not having anything to debate about. But I was trying to still make it a debate about the market in the sense of well, let's talk about where we think this market is going. All right, because I think it still can take a very long time before it gets going the way that we want it to. And I still think that it could take a very long time before the real bull run begins. I know nobody wants to hear that. I know that doesn't sound very bullish of me here and everything. I mean, I don't think it sounds like FUD, but it does sound kind of bearish. But the more I'm looking at the 10-year Treasury, the more I'm starting to think, yeah, this is going to take a lot longer. No, I'm not backpedaling. I still think the bull run hasn't started. But it's possible that it takes longer than I thought it was going to. Because for a long time I was saying, well, September is when it could get going. And there's still a possibility that it gets going in September with the rate cuts coming. It's still possible. But remember what I said for my worst case scenario on the last stream. It might not even get started until next summer. Because what's really holding it up is the money printing that needs to happen. We need the money printing. We need the Fed to start reloading their balance sheet. And there's a lot of obstacles to doing that right now. And that's what I want to talk about today here. Not to make you bearish, not to upset you, not to give you despair, but so that you know what lies ahead and are expecting it, and it doesn't take you by surprise, and you know what you're in for. That's all it is. That's all it is. So, Kent, don't take this the wrong way, Kent. This isn't me saying that it's over. This isn't me saying it's not going to happen. I'm still saying it is going to happen. It's going to take longer, I think. Unless something really happens. So unless there's a major problem this month and the Fed says, yeah, we got to do an emergency cut. Or maybe in October. Could be in October. They meet in October, an emergency meeting, and they got to start cutting. Because the way things are going right now, there ain't going to be no money printing this year, I don't think. Don't think money printer getting turned on this year. And I'll tell you why. But first, let's check out our usual metrics and the things that we care about the most here. Let's see, where do I have all of my stuff? I think it's all here, right? Yeah, it's all right here. All right, how's the market doing today? Let me refresh. Not bad. We see a lot of green here. I mean, it is responding to the bad jobs report released earlier today the way that you would expect here, because this is anticipating rate cuts coming. We'll talk about rate cuts a little bit here today. So far, there's a lot of green on here. We like that. But man, the real troubling thing right now, though, is why I say this bull run hasn't started. Hexo posted something last night that I 100% agree with, and that's this here, is that when you look at where these coins are from their all-time low, there are still several of them that are above 70% down. I mean, Chainlink, a very powerful asset right now, it is 58% down from its all-time high. Athena, that's a very powerful one that's going to have an amazing run, I think. That's down 55%. The darling of the last cycle, Polygon, is down 78%. Ondo, that has everything in the world going for it and everybody interested in it, is down 57%. Goodness gracious, great balls of fire. Algorand is down 93%. Filecoin, which has the best narrative of everything this cycle with AI and with the need for file storage, is down 99%. This is why I say, yeah, the bull run hasn't started. It's not. And it might not start for a while. When you got stuff down this bad from where it had been, it looks like it might take longer to get started. And it's not just based off of the prices that I'm coming to these conclusions. Like, yeah, some of that. Where's the Richard Hart assets here? Still flat. And I think it's going to be flat for a while. It's going to be flat for a while. And I know, like, the marketing stuff is out there and everything. I'm not really talking too much about the marketing stuff. It's not that I don't think it hurts. I don't think it hurts the ecosystem. I don't think it really does anything good for the ecosystem either, though. It'll be interesting to see if it does. I'll be happy. I am 100% happy to be proven wrong about that. If we do a poll later on and it says, oh yeah, I bought just because I got the little drawing tablet from Richard Hart. That's the reason I bought Pulse Chain, why I bought Hex. I am 100% happy to be wrong. Heck, we'll make a t-shirt that says, oh yeah, Cairo was wrong. But I don't think it hurts. I don't think it helps. What's going to help us is the money printer getting turned back on. That's what I want to talk about today. How's the dollar index doing? I don't think it. Oh, it is at 97. Okay, all right. So this is interesting here. We got a weaker dollar. And really, it's going to probably be bouncing back and forth between 98 and 97, I think, for the next week or so until we get word on whether the tariffs get reversed. Like, when there's clarity on the tariffs being reversed, we're going to have like the dollar either like stay in the 98s, probably closer to 99s, or if those tariffs do get reversed, it could push it down to 95 because you're going to have a wider deficit. You know that? And I'm conflicted on like what I want to have happen with that, because like we don't want our president of the country to be embarrassed internationally like that. Even if you don't like the guy, even if you didn't vote for him, you don't want your country embarrassed. But also, the fact that the tariffs have to get, if they get reversed and the deficit gets wider, I mean, that is going to weaken the dollar, and that's good for us. So I'm like one of these guys, like, I don't want something good to happen to me at the expense of others. I'm not that kind of person. But we'll see. We'll see. Don't want to make a prediction on what they're going to do here. I mean, they say that, hey, the courts is pretty stacked with Trump's people. I don't know about that. But we'll see. Here's the real story of the day. The 10-year Treasury has gone down from 4.22 to 4.08. This is what I really want to talk about today here. The Treasury coming down. See, there's something about this that's good, but then there's something about this that's working against us. You remember the yield spread that I keep talking about? I think I got that one over here. No, it ain't there. There's a yield spread I keep talking about having to do with the federal funds rate. Oops. Ain't in here. Let's reload this. All right. So federal funds rate currently is in this range. It's at least 4.25%. That is higher than the 10-year Treasury. And that's, we need those to flip over to get our bull run going. We need those to flip over. They're not flipping over right now, even though we know there's a rate cut coming. Until it's the federal funds rate is lower than the 10-year Treasury, it's staying the same. Because right now the 10-year Treasury is getting closer to 4% faster than the federal funds rate is. But here is some interesting news here. A rate cut is 100% priced in. Now the debate is just over the size of the cut. 90% say it'll just be 25 beeps, but 10% here says it could be 50 beeps. And on the 9th, which is, what is that, Tuesday? Yeah, Tuesday, the 9th, when we get the jobs revisions, and those jobs revisions come in on the 9th, I think you may see this probability go higher, the probability of a 50% cut. I think that goes higher if the job revisions are as bad as I think they're going to be. Now, little housekeeping first here. This book, if you want a free copy of this book, Your Parents Were Wrong, Debunking and Replacing Outdated Advice, you can have this book 100% free. All you have to do is just come on over to my Substack, reinventideal.substack.com. Just put a new article up there. Every article on here is 100% free. It costs you nothing to sign up and subscribe to my Substack. And when you do subscribe, you get a free gift. You get this book, Your Parents Were Wrong. We email it to you. If you want to become a paid subscriber, then you will get another book. Bitcoin Begins, Bitcoin Explained Using Batman. So, you become a free subscriber, you get a free book. Become a paid subscriber, you get 2 free books. This is what I'm talking about today here. This is the Federal Reserve's balance sheet. So far, it's still on the decline. We need it to go up like it did here in 2020 for us to have money printer go brrr and for our assets to pump. But because it's on the decline, that's working against us. This is them letting the treasuries and bonds that they own just expire and mature without buying more of them and reinvesting them. We need this trend to reverse, guys, to have that incredibly powerful, mind-blowing bull market. This is what causes it. And I was looking at federal funds rate earlier. Now, here's some good news. I don't know how well you can see this here. I'm going to try zooming in. Is it going to let me zoom in? This chart kind of tells us the market cycle for the overall investment market. And you can see here, this was 2008. So the red was bad. Lots of bad there. A little bit of mini bad down in 2012. Mini bad in 2016. I think this had to do with Brexit. Real bad over here in the COVID meltdown. See, when it turns like green or yellow, that's when it's reversing a downtrend. And what we can see over here is that we had a downtrend in April. This was Liberation Day. That was the downtrend. And it has reversed, but it's only just come right back above neutral. So it could be that the market cycle for the overall economy just started over, the overall economic business cycle. It could be that it all just started over, which means it supports my theory that the crypto bull market never began. It may take a little bit longer for it to get going. Part of this, why I think that part of it is because of this. Now, some other things I looked at that were interesting here is how often is the Fed too late? Like they're going to be doing a rate cut coming up on Wednesday, not next week, but the week after. Historically, when the Fed cuts, it's already too late. So take a look here. The green line is the 2-year Treasury. The 2-year Treasury is largely based off of what they think the Fed is going to do. They were ahead of everybody else. They were ahead of the Fed. Definitely ahead of the Fed. And then over here, they were ahead of the 2008 crash, because this was 2007 when the 2 years started going down, and then right here when the Fed started cutting. The Fed was late there. COVID, same thing. The 2-year Treasury was going down long before the Fed had their emergency meeting and brought the rates all the way down to 0. And over here, we see, well, the 2 year has been going down on its own. It uninverted the yield curve between the 2 year and the 10-year Treasury. And now, like the Fed is just now talking about rates, they're too late to catch the 2 year. They're not ahead of the 2 year. So it may actually be a case of too late, pal, as Trump likes to say. Here's something interesting. Like, what are they too late for? I think they're too late for catching a recession that we're already in. I'm not going to say, like, oh, we just entered a recession. I think we're already in one. Here's how I think it is that this goes back a good 20 years, and it's looking at the term 401k loan. By the way, taking a loan against your 401k is one of the worst ideas in the long, sad history of bad ideas. I'd say don't ever do it. Don't do that. Terrible idea. Interest in it is going up real high. Almost doubled what it was. We got some other ones here. Missed car payment. Look at that. Interest in that has gone up. Terrible. Late mortgage payment. A lot more Google searches for that. Ooh, particularly in Maryland. They got a lot of... Maryland's a very rich area, so if it's going down there, man, we got some serious trouble. I have no money. That search is going up. It's more than double. Missed payment. Also more than double. So is the Fed late? If you ask Google, they it sure seems to suggest that the Fed is late. And this chart kind of corroborates what I was saying earlier, is that by the time they start cutting, it's too late. Because look at here. The dot-com bust occurred right here. And that was when they started cutting. So it went, like the recession here occurred the same time they started cutting. The great financial crisis, again, it occurred at the same time they started cutting. COVID, same thing. What about right now? Could be the same deal here, where they're, again, just too late. And, that's why they think that 50 basis points is now in play. Now, here's what I got to say about this. Like, there is some good news in this here. Don't take this as me saying be bearish or be having despair or anything, because if they cut far enough, they take the rates all the way down to zero, we just have a few months of pain. Notice, like, the lower they take it, it's right before the red ends. As low as they take it, when they hit the bottom of, like, where they think they need to cut, it's a very short amount of time for where that red is, and then it's up only from there. Like, here was the what they called this was just the S&P 500 going up right here. That's all this was, this black line. So the S&P 500 turned right around. There was just a short lag between when they stopped cutting, when the S&P stopped going down, and then it started going in the right direction. This thing right here suggests, well, maybe there could be some money printing going on, because this here says, well, it's the reverse repo, and it's near zero. It's nearly emptied out. It's nearly emptied out here. The Treasury general account is what we're looking at here with this. See, money market funds, they do reverse repo, but they go buy some higher yields on the secondary market. If you don't know what all this means here, all we got to know about this here is just when it taps zero, it doesn't stay there for very long. And when it taps zero, what happens then is the yields on everything start going up. Which, hey, if the yields start going up, well, in that case, they're going to have to turn on the money printers. If that 10-year Treasury goes above 5%, I don't see how they justify not turning on the money printer. And then this here, what this shows is that China's got the money printer on. And right now, that's kind of what's been pushing Bitcoin up, is China's money printer, because they're doing quantitative easing over there. Will they continue doing it? I think they will have to, with how much debt they got rolling over. Because I've shown you, like, the debt rollovers here for the United States. It's also just as bad over there in China. That's been supporting Bitcoin up there for a while, for about a little bit of this market. So I don't want to stream for like too long here today because, like, I got so much to say about this. I could be on here for 6 hours talking about it. Maybe I'll just do like a little bit of streaming about this subject a couple of times. I'll do a few streams on it. But here's what I want to talk about is knowing what we know now about the world economy, the sovereign debt, the bond markets, the labor markets, the money supply, the actions that the central banks are taking. How likely is it right now that the Federal Reserve starts printing money, starts expanding their balance sheet, or starts up quantitative easing within the next 12 months? I researched this answer as much as I could. I've got a very honest answer for you guys today, and probably an answer you guys are not going to like, but it's a truthful answer. See, if I wanted to be a real putz, I'd just get up here and say, oh yeah, there's a 95% chance that they're going to be printing money within the next 12 months. So yes, get your Bitcoin, get your Hex, get your whatever, get your gold, and don't worry, it's just going to keep going up and up and up. If I wanted to be a real putz, I would do that. But I'm not here to be the most watched or the most loved guy on YouTube. If I wanted to be a putz, I would do that. But what I want is for you to know what to expect. And that's in my interest as well. Like, you guys making my view count go higher or my subscriber count go higher doesn't really help me because the channel's not monetized. But you guys knowing what to expect so that you can hold your investments, well, that does help me. Although the news I'm going to give you today is not great news to receive. You know it's true. That's how you know it's true, is because it's not the most pleasant thing to hear. So, let me ask you guys this question. Throw your answers in the chat. Percent, on a percent, between 1 and 100%, what is the likelihood that you think the money printer gets turned back on within the next year? What do you guys think? What is the percent that you think it is? Throw your answers in the chat. I need another drink. Be right back. And why am I putting so much stress here on money printers? Because printing money is what causes the real bull run. The real big bull runs, that comes from printing money. This is why I think the institutions are grabbing up as much crypto as they can right now, because they recognize money printing is going to come. Is it in the near future or is it just in the future? I mean, we know it is just in the future because it's the only solution that they have. But is it in the near future? Or how near of the near future is it? Now, I will tell you this here. The main thing that has me thinking that it is possible we get money printer coming on in the next 12 months or less is that the midterms are coming up and the politicians in power want to get reelected. Money printing is a reliable strategy to help them get reelected. That's what I see. So, I guess nobody has a guess here on what is the likelihood of the money printer getting turned back on, because nobody's said anything. So I'll tell you, here's where I put it. Within the next 12 months, it doesn't look good. I imagine I put it somewhere between 10 and 20%. And here's why, is that growth is just now starting to soften, or at least the way they measure it. Inflation, the way they measure it, is slightly above target. Unemployment, even though they're measuring it dishonestly, it's going up a little bit. Not by much. Like it went from 4.2 to 4.3. Still got a lot of quantitative tightening programs going on. And the central banks seem to be more focused on gradual and slowly gradual interest rate cuts to support the economy. And they want to do that instead of expanding the balance sheet. Now, the interest rate cuts are good. The interest rate cuts are good. It's going to help push prices up a little bit, I think. I mean, that's just like the laws of physics here, that if interest goes down, prices have to go up and vice versa. It's not always that simple, though. There are some other things that can get in the way there. But let's talk about like why I think it's very low that they turn the money printer on in the next 6 to 12 months. And this was like kind of what I was going to argue in the debate with Pedro, as he was thinking, well, bull run's got to end soon. This would be something that if I get to have my discussion with T-Bird, I definitely want to talk about this with T-Bird, because he thinks that the bull run has to end before New Year's Eve this year. So I want to show him like this stuff here and say, well, T-Bird, what do you think of this? Because like the global economy has had moderate growth with just occasional weakness, but it has not had any widespread recession signals that would prompt an aggressive quantitative easing or money printing. All right. We've had some moderate growth. You need to have like some negative growth in order to get them to think, oh my gosh, we really need to start printing money. All right. Okay, Kent says 90% chance for the next 12 months. Yeah, I hope you're right. And like in the debate, what I'm really hoping, and when I talk to T-Bird, what I'm really hoping is that he is right and that he can convince me that he's right. Because when I do these debates, they're not so much for me to like be all big Mr. Macho Man going, oh yeah, look at me, I'm so right. You all need to listen to me from now on, even though occasionally I do act that way. It's not about me being a macho man. It's about me thinking, I want someone to prove me wrong in case I am wrong. Show me where I'm wrong. I am happy to be wrong. I want to be wrong. I want T-Bird to be right. I want this thing to be over within the next 3 months, because I'm happy to just sell everything and not have to worry about all this stupid volatility. Like, this whole market has been incredibly stressful, so for it to be all over within a few months would make me really happy. I just don't think that's going to happen based on what I got to report here. Yeah, here's the thing. It's like the Fed's balance sheet had peaked at $9 trillion back in 2022. Let me show you that. Where do I got that? I got that over here. Yep. All right, so up here, 2022, it was almost 9 trillion, not quite, but pretty close. It had peaked there. And like since then, they've allowed everything to just sort of run off. They call that tapering. And the same kind of goes for the European Central Bank. Like their balance sheet has shrunk from 8.8 trillion, I think euros? Yeah, they measure that one in euros. And they've been letting things wind down. And the rates that they have, the rate that they care about the most is the deposit rate. That's like their version of the federal funds rate. That's at 2%. And they don't have any plans for QE right now. They're not talking about QE right now. Bank of England is reducing their holdings as well. They're reducing their balance sheet and prioritizing tightening right now. The Bank of Japan just recently ended their negative interest rates, and that's doing some cautious tightening. All right? The only ones that are talking about like expanding their balance sheets are third world countries like Brazil. Now, what could affect this likelihood? A few things. Like if we got a deeper labor market slowdown, like if the revision comes in on Tuesday and it says, there's 1 million jobs that we lied about, they're not there. That can cause it. That can change everything. If unemployment were to spike up to 5%, I don't think it will, because they're very dishonest with how they measure unemployment. Unemployment rate's a lie. It's an absolute lie. And it's crap. When you think about this, how the measurement is taken, it's just crap. It's not worth anything. If we got bond market volatility from sovereign debt getting too high and geopolitical risks, which is true, we do have a lot of that, that could change things. If we get deflationary pressures, like they do their inflation measurement, and it's less than their 2% rate. Or they catch a deflationary period, they're gonna have to print money. Only way they fix that is printing money. If these rate cuts that they do prove to be insufficient at saving the economy from a recession or from the labor market getting worse, if they cut the rates and nothing gets better, they will have to do quantitative easing. So they are going to have to do it at some point. It's just, can we see one of these things happening for sure within the next 12 months? I can't say for sure. That's the problem, is saying for sure. Now, substantial debt rollover and refunding, constantly issuing new debt, new treasuries, and rising interest costs. Well, that's a problem too. And that does increase the likelihood of money printing. And that's what I'd been saying is like going to really push them to do it, is the fact that the debt is just getting out of control. But I think that only raises the estimate from 20% to 30% of how likely they are to turn the money printer back on. And here's why. It's just looking at how the bond market has been handling things right now. So far this year, and this is what set me off to do this, guys. What kind of set me off to talk about this like this here is that I saw the bond market, the bond yields go down today. I saw the bond yields go down. And I was not expecting that. I mean, right now, the 10-year Treasury has gone from 4.22 to 4.08. That doesn't look like much, but that's trillions of dollars. And what we need to have happen is we need to have the federal funds rate go below the 10-year Treasury. Right now, the 10-year Treasury has front-run the cut coming to the federal funds rate. Even unless they cut it by 50 basis points coming up at this meeting, it's going to stay having the federal funds rate above the 10-year Treasury. We need those two to flip. Typically, those two flip, though, when there's a disaster, when there's a 2008, when there's a COVID, some black swan event. And that's maybe what it's going to be. There's going to be some black swan event nobody was thinking of. What could it be? I mean, I showed you screenshots here of what people are thinking on Twitter about how the economy is pretty bad for most people. I've shown you you saw the labor statistics today that came out. I've shown you like how everything is so secretly bad. You know, the jobs that they keep saying are there, it turns out are not there. So maybe there's a hidden recession that they're trying to hide. Maybe the disaster is they can't hide it anymore. And like this giant orgy of evidence bursts out and shows, hey, the United States is in a recession. And you damn well better start cutting and fixing those rates because you damn idiots have been trying to hide this for a long time and you made things worse. Maybe that's what happens. I'm hoping that they just stop lying and tell the damn truth. I think that it's going to be unignorable coming up in October when the Q2 figures for GDP growth by state come out. Remember that map I keep showing you that has all those states that are in red? It's not because they're Republican states. It's because those states had negative GDP for quarter one. In October, we're going to get another one of those charts for quarter two. It takes a long time for them to get accurate measure of that. If quarter two looks just as bad, where 39 out of 50 states are in red, well, then that is a recession. They can't keep lying about it and say, oh, no recession. Oh. They can't keep lying about it anymore. Probably going to have an emergency meeting by the Fed, and we're going to have to cut these rates. They're going to have to cut these rates so much that the federal funds rate goes down below the 10-year Treasury. And then we're going to have a very difficult time ahead of us when that happens, yes, because usually what that signals is pain, a bad economy. But once the pain is over, and it'll be over within a few months, then we can really get going. All right, like think back to 2008. Like that was the worst of the worst, right? Really, the pain was finally being acknowledged in October or September. We'll give it, say September. And it lasted all the way up to March. March was the official bottom of the economy. From there, it was up only. They were printing money the whole time from 2009 all the way up to 2016. All they did was print money. It could happen again if they lift up the rug and show, oh yeah, we've been sweeping dirt under the rug here this whole time. We've been lying all this time. Here's all the dirt we've been trying to hide. We're sorry, we can't really hide it anymore because, all this hiding that we've done here has just caused it to get worse. Maybe that's what makes this, maybe that's what gets this thing started. I'm not hoping for that. I'm not rooting for that or anything, because I'm not rooting for bad things to happen. But we need something bad to happen for the money printer to get turned on sooner. And I think it is going to get turned on eventually, but for it to get turned on within the next 12 months, something bad's got to happen. And I'm not rooting for anything bad to happen. Now, projections for the next 2 quarters, they anticipate about needing to borrow $1.5 trillion with Treasury bonds. And is the demand there to buy that much in Treasuries? That still remains to be seen. If everything stayed like it was today, there's enough demand for Treasuries to buy those Treasuries so the yield doesn't go up above 5%, which would trigger them to turn the printers on. If everything stays like it does today, there's no guarantee that it stays like it does today. I mean, it could be oh, you're going to issue more debt? Screw you. We ain't buying more from you then. Because you see, it's one of those things you as a person, you as a human, if you need to borrow more money, you have to pay a higher interest rate. The more debt you get into, the higher your interest rate's going to be. Government has a way around that, a sneaky way around that. So new debt issuance projections. Well, there's net new borrowing of about $1 to $2 trillion before 2026 rolls around. And the debt to GDP is going to be 118%, which is not good. And that does increase the likelihood of quantitative easing. But what you need to have happen is what you need to have happen for that to occur is you need it to crowd out private investment and raise borrowing costs across the entire economy. You see, when the Treasury yields go up, that means the yield on every other bond goes up too. And I think you can see that from the chart here. Let's take a look at that. Can we see it? Go back to Fidelity. Because the Treasury yields are so high, the 10-year is over 4%, notice that everything else in this column is over 4% as well. Everything else in this column is higher than the Treasury. That is not an accident. Because why in the heck would you borrow, or why in the heck would you lend to a corporation that has risk when you can lend to the government, supposedly risk-free, and get 4%? Why would you ever lend to a corporation if they weren't going to pay you more? So it has to. It has to be higher. If the Treasury goes up higher, if the yield goes up higher, the yield on everything else goes up higher, that means corporations are going to have a really hard time raising money. That's going to slow down the economy. The only way you're going to fix that, if it gets too high, is with money printing. I do think it's going to happen. I think it's going to take a long time, though. I think it could take some time. All right. Kent, what do you say here? I hope, because lots of people are so bearish, we go up when we least expect it and leave them behind. Then the narrative changes. Everything is so upside down nowadays. Everything's a lie, so who knows? Yeah. So here's what I think is going to happen here. If this bull run doesn't get started till next summer, a lot of people in crypto right now are going to be selling out in January. They're going to think, oh, that was the saddest, sorriest bull run ever. This crypto thing is real stupid. I'm done investing in this crap. I feel ripped off. I feel gypped. mean, Ethereum's new high was only $100 higher than the previous one. That's crap. I'm not investing in this. They throw their investments away, selling them down, and BlackRock catches them all because they got limit orders to catch these red candles. And Fidelity catches them. Arkham catches them. Trump's organization catches them. So really, when you do that, you're just giving all of your assets to the institutions who are going to try to sell it back to you at a much higher price. But these people that do that, when they finally give up, you know what's going to happen? They're going to miss a big chunk of the gains when they start coming. They're going to miss probably the first 3 months of the real bull run when it gets going. And when that happens, they're going to be the ones that are buying the top in the end. And I think that's exactly what these institutions want. That's why the institutions are making the moves that they're making. They want you jeeting out right now. They want you to give into despair so that they can sell it back to you at a higher price. Now, when we think about like the rising interest costs on the treasuries, I mean, that is exacerbating the fiscal strain that the government's feeling. That is leading to what Lynn Alden calls fiscal dominance. And it is consuming more budget resources. And it is going to force them to have to issue more treasuries. It gets vicious, very vicious cycle. Net interest payments are projected to be $1 trillion in 2026. They're not quite $1 trillion right now. That's why I think it may have to take longer. But when the interest on the national debt is $1 trillion, we're in for some really rough times. We got a very difficult time ahead of us if that happens. When that does happen, they are going to have to print money to fix that. I don't think there's any way that they can get around that. I mean, there's going to be so many people ringing the alarm bells when you got $1 trillion in national debt interest. I mean, it would be about that would make it like 3.3% of GDP if you had $1 trillion in national debt interest. That reduces fiscal flexibility, and it increases what Lynn Alden calls the risk of fiscal dominance, where the Fed needs to monetize the debt with QE to keep those rates manageable, especially if inflation gets under control, if it remains tame. All right, if the inflation readings that they do between now and the end of the year turns out, inflation's totally under control. It's 2% by whatever BS standard they're using. That fixes a lot of this, because then QE can come back. The big problem that we got, though, is do we have enough demand and willingness to buy government debt? Is there enough people willing to buy these treasuries to keep those yields down? That's the real problem that needs to be solved, or the real problem that QE is going to be, the money printer is going to be turned on to solve. They're going to use the money printer to solve that if they can't solve it the old-fashioned way. Right now, overall auction demand remains pretty robust, because foreign investors, they bought 65% of the bonds that were offered in the June 2025 auction. Foreign holders, right now they're at a record high. They have about 30% of outstanding treasuries. But just because they have that many treasuries right now, that doesn't mean they will continue to have them. When these treasuries start maturing, they may not buy more, and they may slowly divest the old-fashioned way just by letting these treasuries mature. I can see that happening, because there's cracks emerging. Like foreign central banks have been net sellers since March 2025, and they've been declining their participation in the 30-year auctions. That's how the 30-year treasury went over 5%. And overall, like the foreign demand, it doesn't look like it's going to get any stronger than it is now. It looks like it's just going to get weaker. Custody holdings were $3.2 trillion as of the beginning of this year. Diversification away from U.S. dollars and U.S. dollar-denominated assets is a real concern going on out there. Net foreign purchases have been positive. Back in May, they were positive. But if it's weak and we have sustained weakness, That's going to lead to higher yields. If that demand softens because we got geopolitical tensions, it could cause the foreigners to sit out the auctions and push the yields up. That hurts the economy. And because the economy is hurting, they got to do quantitative easing. They got to turn the money printer back on. And you know that they're going to do that before the midterms. Yeah. The thing with what can really heighten the possibility of money printer getting turned on sooner? A lot more issuance of treasuries, a lot more issuance of debt, a lot more debt rollovers, higher interest costs. It all just creates a feedback loop. They call that like the debt death spiral. I'll do a stream just on that. Because more debt leads to higher rates, which inflate costs and necessitate even more borrowing. And then you got more debt, and then higher rates, and then more debt to pay those higher rates, and then higher rates because of that more debt. And then you got to get more debt to pay those higher rates. There's no end in sight. Like the only way you bring it down is through quantitative easing. So it's going to happen at some point. You need demand to falter. You need the yields to spike. You need to slow down the growth of the economy. And that prompts the Fed to buy the assets and lower their long-term rates. Effectively, but they do that. They print money. Historically, quantitative easing, money printing, reduces Treasury borrowing costs. And a rising debt increase is inflationary. In the last Fed meeting, I think that they released the minutes here. They always keep saying, oh, we got this data-dependent flexibility. We're going to be data-dependent. A debt-driven yield surge, though, could really set them off and leave them with no choice. So what I want to say is, like, this isn't totally inevitable within the next 12 months. Because right now, demand is holding. And if the Fed rate cuts that come in help everything, well, then they might think, well, we don't have to do QE. If the rate cuts don't help the economy, they may have to. They may have to do it a lot sooner. So that's the thing I want to say about today. Is I want to cover, how likely it is. I want to talk about how likely it is that they cut rates. Right now, it's not that, or not. How likely it is they print money. Right now, it's not that likely. It can get more likely as time goes on, but right now it's about a 20% chance they turn the money printer back on. All right. Now, let's see. Is the current amount of debt that they're issuing, is there enough demand to support it? Based on what data is available right now, it is sufficient to absorb the new debt that we expect to come out over the next 12 months. But we got to make a lot of assumptions to say that. And I'm not so sure that the assumptions that the experts are using are ones that you can really rely on. Because they're looking at, well, how much are the foreigners buying? And the foreigners have bought up 30% of U.S. debt. And my thinking is, well, yeah, they bought 30% of U.S. debt, but are they going to continue to do that? Is there any guarantee that just because they bought that much in the past, they're going to keep buying that much? The main thing that got them to do it in the first place is that there's not much alternative elsewhere for safe bonds with a safe return. There's not much alternative elsewhere, and that's why they had bought the U.S. Treasuries. And that's why they continue to buy them. However, governments all around the world are having their bonds go down in price and their yields spike up. There could be more competition now for the best yield. So it depends. Do these foreigners want higher yields or do they want safety? I can't answer that question because I don't know how they all think. But we'll see. Time will tell. Global public debt, though, not just here in the United States, but I see all around the globe, government debt has surged to the highest levels they've ever been, and a lot of it is still pandemic legacy problems. problems that they are carried over from the pandemic. They've always had like very persistent deficits. Like 80% of the global economy is seeing the debt higher and rising faster than it was before the pandemic. Developing countries, they hold about $31 trillion of total debt. So it's less than a third of worldwide total. But that's a disproportionate problem here. They have disproportionate risks, so their borrowing costs are 2 to 4 times higher. So those developing and third world countries, they could be running to quantitative easing a lot faster than we could be. And not that I celebrate it, but that is a good thing for crypto. Because when your local currency in your third world country is no good, what are you going to do? You're going to turn to Tether. You're going to turn to USDC. You turn to Tether, USDC, and everything. What does the stablecoin issuer have to invest the money in? They got to invest it in T-bills. And that brings down the lower end of the yield curve, which is good. We like that. Now, how stable is it all? Like in the Eurozone, the central bank balance sheet is shrinking. It's down about 25% from the peak that it was at in 2020. Not a high likelihood of money printer getting turned on in the Eurozone yet. They're probably going to do more rate cuts. When they do the rate cuts, and if they don't work, then they turn on the money printer. In Bank of England, or the UK, well, there it got kind of the same thing going on. Like they're shrinking their balance sheet. So low likelihood of them raising it. What they're going to be thinking about is probably they'll do it as a last resort over in the UK, I think. Now, in Japan, they're trying to stop doing QE. They're trying to exit from it. But they could come back to it if they have a deflationary problem. And it's very easy for them to have a deflationary problem just because of their population. To like make sure you don't have deflation, you need to increase your population and replace it. They're not doing that in Japan. Not a lot of sex going on over there. In China, that one they are doing the money printing. They're doing some stimulus over in China. And it's a very about a 50% chance that it keeps going on. If if the bonds don't sell to private investors, if that bond growth slows down, bond sales slow down. In the emerging markets, the developing countries, the third world, that one looks like they got a lot of problems there. They got a lot of problems there. Japan's got a really big problem. Like 250% is their debt to GDP. It's 250%. UK, it's 100%. In the Eurozone, it's 90%. Emerging markets, it's a little over 80%. In China, it's 80%. Here in the United States, though, it's 118%. If those debt to GDPs keep getting higher, money printers got to get turned back on, and then we all get rich. Yeah. The Eurozone, they're reducing their balance sheet. Same with Bank of England, Japan, China, the emerging markets. But let's get back to the U.S. economy here for a moment. Is it possible that other entities, besides the central bank, can print money? Yes. Now, what is the likelihood that they're going to print a large amount in the next 12 months? Because you see, other entities besides the Federal Reserve can do money printing, like commercial banks being the big one. They expand the broad money supply. They issue loans. They create new deposits. This is different from what the Fed does with quantitative easing. Private companies and even like individuals can theoretically issue their own forms of money. I mean, with individuals, you use your credit card, that creates more money, that expands the money supply. But the likelihood of a large amount of money creation from this in the next 12 months, that's still pretty low. About 20 to 30% is what I'd estimate. Because when you look at what the bank lending growth has been lately, it's been pretty modest. When you look at the economic conditions, I mean, there's just so much uncertainty about it, and we're not even sure if we're measuring it properly or if what they're telling us comes from proper measurement. So we can expect a moderate expansion of around 4 to 5%, driven by rate cuts from the Fed. All right. I think the commercial banks will be able to do most of the money printing for the next 12 months. And then some other private entities as well, which is good. We like that. If the economy is doing bad, though, that's when the Fed's going to have to step in. See, like when these private entities, when these commercial banks are doing it, that's typically a sign that the economy is good. Because I'd say as well, there's a lot of growth going on in the economy, and people need to borrow money to fund that growth. But until it gets really bad, that the Fed has to step in and do their like forced growth of the economy through quantitative easing, I don't think we get like any meaningful money printing from that until the Fed does it. All right. So I know that like this is not the usual. This is not the usual super optimist. Me being the boltard that I usually am. Yeah, I'm like the male version of Wild SJ. You know, I'm your positivity prince. But this isn't to despair you. This isn't to tell you that, hey, it's all over. I'm not saying it's all over. No, it's not all over. I'm saying it's going to take longer if everything continues. The way that it changes is, one, how big of a rate cut do we get in 2 weeks? That's the next most important thing. The second most important thing is what is going to be Jerome Powell's tone. Is it going to be hawkish or is it going to be dovish? Is he going to cut and say, hey, I think we might have to do some more cuts in the future? And if so, great. In that case, we got a very dovish Fed, and then you're going to see probably the assets go up a little bit. If he's going to cut and then be very hawkish, be like, I'm cutting, but man, I really don't want to, like he did back in December, that's bad. You're going to see prices go down. There's also a possibility that they cut, and they're cutting because they're too late to stop a disaster from occurring. Prices will go down. Where is my mind at right now? I'm going to be honest with you guys. I think we have a difficult time ahead of us. This month will be very difficult. I think Q4 will be very difficult. I could change my mind on that. When I do my talk with T-Bird, when we have our discussion, I'm hoping he changes my mind. I don't have anything right now to make me think otherwise, but I think we have a difficult Q4 ahead of us. When that's over, depending on the fallout, depending on like where the market's at, when that's over, I may think that, hey, now it's time for the bull run to begin. It all depends on what these interest rates are doing. It all depends on that yield spread between the federal funds rate and the 10-year Treasury yield. It depends on the dollar index. And then what the Fed balance sheet is doing. All of those things are working together. And you got to watch them all because they all are connected. They will tell you exactly what's going to happen for the next year. Right now, what they're all telling me is that a bull market is not starting for a while. It could take all the way until summertime next year to get going. And why I say that, like why do I think it takes to summertime? Midterms are coming in. They're going to be campaigning for the midterms. Jerome Powell will be out, and Trump's going to put in Fed chairman and Fed governors that will do his agenda. And then there's no such thing as Fed independence. Rarely is the Fed ever independent. They always do like what the president who appointed them says to do. And then a lot more of the debt has been cycled through by then. And then we can see what impact that has on these interest rates. Does it cause the yields to spike and go up, or will these yields hold, or will they go down? And also, maybe we'll have had 3 rate cuts by then, and we can see how well of those rate cuts worked out in our favor and in the economy's favor, and what's going to happen there. So I'm not saying be bearish. I'm not trying to give you any despair. I'm telling you, be prepared just in case this bull run doesn't get started until next summer. That is a real possibility. It's not a possibility I want to see. It's not what I want to have happen, but it could happen. In case I am wrong, like it starts going up. I mean, one, I'll be streaming and telling you what I think if it starts going up. But what you got to do here is you got to set prices now for your top calls. Like, what is the price where you say, I've made enough money on this, it's time for me to start dollar cost averaging out? Do that now. Because who knows? If the rate cuts in 2 weeks are good for us and we start going up, it can go up very fast. But then it could also go down very, very fast as well. We don't want it to go up too fast because then it will come down very fast as well, just from like the way that prices retrace. So this is like the best thing I can tell you right here is you DCA'd on the way in, you got a DCA on the way out. Set your price now for when you're going to start do that. When you think the top is for you personally, not the top for the overall market, but like when you're looking at a coin like Hex, like you say, well, I think it's going to do $1 this year, and it might not do much higher than that. Okay, well then when it hits $1, that's when you're going to start DCAing out. That's what I mean. Not telling you to do that. Use the price of $1 to DCA out. I'm telling you that is an example of what I mean. Pick a price now for when you're going to start DCAing out. All right? Pick that price now. And also, use that not just as the price to watch out for when the bull run gets going, but use that as the price to remember if it takes longer for this bull run to get going. It can take longer, guys. I know that I've depressed M. Belta there. I see that you've posted something. If we have to wait till next summer, that really sucks. I mean, I agree. It really sucks. But you know what's better, or you know what's worse? What's worse than waiting until next summer is if the bull run was already over. But I'm telling you, it hasn't even started yet. It hasn't even started. So what's worse than having to wait till next summer is it already started, and it was a real piss-poor bull run, and it's already over. So I'm going to tell you this here. I'm telling you this, and we'll talk more about this here. Like, what's it going to take to get the money printer on and everything? We'll talk more about it. But this is what I want to do here to give you, like, the best information. And so that you know I'm not just some positivity pimp out here trying to pump you up with a whole bunch of platitudes and feel goody good crap just so that you'll watch me. Like, if I lose viewers over this stream, fine, I lose viewers over this stream. But the point here is I want you guys to have the most accurate information. Right now, I don't see enough reasons for them to turn the money printer back on. It could take longer before they turn it back on. That's all I've got to say for today. Cairo out.